The silver market just cracked open something the financial world has been trying to hide for a very long time. Paper says $83. Shanghai says something completely different. 24 days of supply are left. And the world's most secretive trading firm just placed a $1.3 billion bet on it. Stay right here because this story matters more than you think. What is good, everyone? John OG here. I go deep on global finance, macro, and crypto. No noise, no hype. Just the data that actually tells the story. Let's get into this properly. Before we start, everything in this video is strictly for educational and informational purposes. Nothing here is financial advice. Markets are volatile. Please do your own research and speak with a qualified professional before making any financial decisions whatsoever. Let me tell you what is actually happening in the silver market right now, because the numbers are so strange, so contradictory on the surface, that most people see the headline and move on without understanding the deeper story. And the deeper story is genuinely significant, not just for silver investors, but for anyone watching how the global financial system handles pressure. Start with the most basic and most disturbing fact. As of March 2026, there are two different prices for silver existing simultaneously on the same planet. Paper silver, traded on the COMEX futures exchange in New York, is sitting around $83 per ounce. Physical silver, traded on the Shanghai Gold Exchange in China, has been commanding prices that at various points in 2026 reached $95, $109, and earlier in January touched $121 per ounce, a level that was briefly the highest price ever recorded in silver's history. That price gap between what the paper market says silver is worth in New York and what the physical market says it is worth in Shanghai should not exist in any normally functioning commodity system. Arbitrage, the mechanism where traders buy cheap in one market and sell expensive in another until the gap closes, is supposed to erase these spreads automatically. The reason arbitrage is not working is the same reason this crisis is different from anything we have seen before. On January 1st, 2026, China implemented strict export controls on refined silver. China controls roughly 70% of the world's refined silver supply. When China stops that metal from flowing freely to Western markets, the arbitrage route breaks. Physical silver that is priced cheaply in New York can no longer be offset by importing from China. And the result is exactly what we are watching. Two prices, two markets, and a fracture running straight through the foundation of how silver is priced globally. Now let me explain the 24 days figure because this is the number that has the institutional market genuinely on edge. COMEX, the exchange where most of the world's paper silver futures contracts are traded and settled, holds what are called registered inventories. These are silver bars that are specifically designated and available for physical delivery against futures contracts. By the end of February 2026, registered silver stocks had fallen to approximately 86.1 million ounces. That is a 31% decline from levels seen just months prior. On the first notice day for the March delivery contract, delivery notices were issued for 10,526 contracts, representing roughly 52.63 million ounces of silver. That is more than 60% of the total registered inventory being demanded for delivery in a single month. The 24 days figure refers to the estimated time before COMEX registered inventory would be fully exhausted at current demand rates, assuming no significant new deliveries flow in from outside the exchange. To put that bluntly, if every contract demanding physical delivery in March 2026 actually takes the metal, the COMEX does not have enough silver in its registered vaults to fulfill the obligations. Not even close. In response to this building pressure, the CME Group, which operates COMEX, took an extraordinary step in mid-February 2026. They raised silver margin requirements from 15% to 18% in a single move. What that does in practice is force highly leveraged traders to either deposit significantly more cash to hold their positions or close those positions entirely. The result was a violent leverage unwind that sent silver prices crashing from above $90 back toward the $83 range in a matter of days. That is not a market move driven by a change in the supply or demand of physical silver. That is financial engineering, using margin requirements as a tool to drain demand from the delivery queue and buy the exchange more time. This is the part of the silver story that I find most important to understand, And I want to be genuinely nuanced here because there are two very different ways to read what is happening. The first reading is that the COMEX system is under legitimate structural stress, that the combination of China's export controls, record industrial demand from solar panels and electronics, silver's new designation as a U.S. critical mineral in late 2025, and years of market deficits have finally created a physical shortage so acute that the paper pricing mechanism is beginning to fail. The second reading is that the pricing moves we are seeing are being actively managed by institutions with enormous financial positions on both sides of this market. My honest view is that both things can be true simultaneously, and the Jane Street story is the reason why. Let me walk you through the Jane Street filing because this is the most extraordinary data point in this entire story. Jane Street is one of the most profitable quantitative trading firms in the world. They are not a household name, but they are enormously influential. Their business model is built almost entirely on options and derivatives. Over 87% of their reported $662 billion portfolio sits in options, according to their latest filings. They make money by creating and trading volatility, by positioning on both sides of large price moves, often simultaneously, in ways that most retail investors would never see or understand. They are not, by design or reputation, a firm that takes large directional bets on physical commodity prices. And yet, in Q4 2025, Jane Street added 20.6 million shares of BlackRock's iShares Silver Trust, known as SLV, in a single quarter. That is a jump from approximately 41,000 shares the prior quarter, a 500 times increase in one quarterly filing. The position is worth approximately $1.3 billion, and it places Jane Street above BlackRock itself as the largest single holder of the world's biggest silver ETF. BlackRock, for context, added 0 new shares in the same period. Morgan Stanley sold 3.7 million. The question that everyone in the precious metals and macro community is asking right now is simple. Why? Why does the most volatility-driven, options-heavy trading firm on the planet suddenly want to be the biggest owner of a physical silver ETF at exactly the moment that silver's paper market is under its most acute delivery stress in modern history? And why does that position exist alongside the same period in which silver went from $83 to $121 and then violently reversed? There are 3 possible interpretations. The first is that Jane Street is positioned to profit from further volatility, regardless of direction, using the SLV position as part of a broader option structure that makes money whether silver explodes higher or collapses lower. The second is that they have genuinely concluded, based on their own research, that the physical silver thesis is sound, and they want directional exposure at scale before the next leg higher. The third, and this is the one that the zero hedge analysis and several market commentators have raised directly, is that a large SLV position in the hands of an options-heavy firm can be used to influence the paper price of silver during critical delivery periods by providing the appearance of demand while simultaneously managing price through derivatives. I am not making that accusation. I am presenting the question that the market is asking because it is a legitimate one. What makes the question harder to dismiss is the context. Jane Street is currently facing serious allegations across 3 separate asset classes. Terraform Labs' bankruptcy administrator has sued the firm for alleged insider trading during the 2022 Terra collapse, claiming a Jane Street-linked wallet pulled $85 million in UST from a liquidity pool within minutes of Terraform's unannounced withdrawal. In India, the Securities and Exchange Board of India accused Jane Street of manipulating the Bank Nifty index across 18 derivatives expiry days and ordered it to deposit roughly $566 million. In crypto markets, traders spent months accusing Jane Street of running a systematic daily pattern of selling Bitcoin at 10 a.m. New York time, a pattern that allegedly broke only after the Terraform lawsuit became public. Jane Street has denied all of these claims, calling the Terraform suit desperate and baseless. No regulator has opened a formal silver investigation. These are allegations, not convictions. But when the same firm faces accusations of systematic behavior across equities, stablecoins, and crypto, and then builds the largest position in the world's biggest silver ETF at exactly the moment the silver delivery system is under maximum stress, the coincidence is too structurally significant to ignore. Now let me give you the bigger picture, because this story is not really about Jane Street. It is about what the silver market is telling us about the global financial system more broadly. Silver was added to the U.S. critical minerals list in late 2025. That designation matters enormously. It means the U.S. government officially recognizes that silver is not just a financial asset or a jewelry metal. It is a strategic industrial resource that national security depends on. The photovoltaic cells in every solar panel require silver. The wiring in every electric vehicle requires silver. The advanced electronics in AI chips and defense systems require silver. When Elon Musk posted on X in response to China's export restriction announcement and wrote simply, "This is not good. Silver is needed in many industrial processes," he was not being hyperbolic. He was being accurate. The structural silver deficit is not new. The market has been in a production deficit for multiple consecutive years, meaning the world is consuming more silver than it mines each year. The difference has historically been made up by above-ground stockpiles, recycled silver, government reserves, exchange inventories. But those stockpiles have been steadily draining. What China's export controls did on January 1st, 2026, was shut the valve that had been keeping those stockpiles topped up. And the result is what we are watching. COMEX inventories at multi-year lows, registered stocks covering barely enough for the March delivery cycle, and a persistent premium of $8 to $13 per ounce in Shanghai above whatever price the New York paper market chooses to print. The paper-to-physical silver ratio, the number of paper claims on silver that exist for every physical ounce that actually exists in deliverable form, currently sits at approximately 378 to 1. That means for every ounce of actual, deliverable silver on the COMEX, there are 378 paper contracts claiming a right to it. In a normally functioning market, that ratio is managed through cash settlement. Most contract holders never actually want the metal, they just want the financial exposure. But as the March 2026 delivery cycle demonstrates, when enough holders start demanding the physical metal, the system runs out of room to maneuver very quickly. Large-scale electronics manufacturers and solar producers are reportedly already responding. Many are negotiating off-take agreements directly with silver miners, bypassing the exchange system entirely to secure guaranteed supply for their production lines. That shift away from just-in-time delivery through exchange warehouses is not a temporary adjustment. It is a structural change that will further drain exchange inventories over time and make the paper pricing system increasingly disconnected from physical reality. My personal view on all of this, and I want to be transparent that this is my read of a genuinely complex situation, is that we are watching the beginning of a long-term restructuring in how silver is priced and valued globally. The COMEX will not necessarily default in March 2026. The exchange has tools, margin hikes, cash-settled alternatives, the ability to change delivery rules that can extend the timeline considerably. But every tool they use to delay the physical reckoning also increases the credibility gap between the paper price and the physical price. And that gap, once visible to enough institutional buyers and industrial users, does not close quietly. The deeper question this raises is one that connects to every asset class, where the paper representation of value has drifted far from the underlying physical or fundamental reality. We have seen this dynamic in credit markets before 2008. We are watching it in silver now. And the institutions that understand it earliest, whether they are positioning correctly or not, tend to shape what happens next in ways that the rest of the market does not see coming until after the move has been made. What I am watching over the next 30 to 60 days is the COMEX inventory data very closely, specifically the registered category, which tells you how much silver is actually eligible for delivery as opposed to just sitting in an exchange-adjacent vault. I am watching whether the Shanghai premium persists, narrows, or widens further. I am watching whether industrial users announce further off-take agreements that remove more supply from exchange channels. And I am watching what Jane Street actually does with that 1.3 billion SLV position, because a firm that lives on volatility does not buy a position of that size without a very specific thesis about what is going to happen next. That is everything I have got for you today. This is one of the most complex and consequential stories unfolding in global finance right now, and I wanted to give it the attention it deserves. If this gave you real clarity on what is happening, hit that like button. It genuinely helps the channel. Subscribe and hit the notification bell so you catch every video. Drop your thoughts in the comments below. I read every single one, and I want to know what you think about the silver market right now. I am John OG. Stay grounded, do your own research, and I will see you in the next one.